Good morning and welcome to the internet's only daily live housing show. The hot sheet covers what you need to know about the real estate industry in a 24-hour time period. On today's hot sheet, I will discuss rent growth deceleration, multifamily housing, house flipping, and a mortgage update across the board. Today is Wednesday, June 21st, 2023. I am Byron Lazine, and the hot sheet starts now. All right. Good morning, everybody. Let me know in the comments where you are tuning in live from. If you are on the live chat, or even if you're on the replay later today, let us know where you are tuning in from. If you'd like to tune in to the best way to actually get this content, it's on BAMX. All of our daily downloads have been moved over to BAMX. And so for those that have signed up for the daily download email, you don't need to worry anymore about getting an email. Just go down below and sign up for BAM X so that you can get all the access to everything that we do here on the hot sheet every single day, all in one place. I am in one place, in one mindset on rent deceleration. I've been saying rent prices are coming down, and they've been coming down all year. I'm in the Barry Sternlight camp, CEO of Starwood Capital. I'm in Redfin's camp. I'm in basically almost everybody's camp except for Jerome Powell, who just can't see it. CoreLogic now, as of yesterday, reports the same thing. U.S. single-family rent growth continues year-long descent in April. Single-family rent growth continued to slow year over year in April to 3.7%, down from about 14% at the same time in 2022. All U.S. metros for which CoreLogic tracks data saw rent increase by single digits or less, except for Las Vegas, which posted a small annual loss. Okay, so these are well off these double-digit increases. And in fact, we are nearing pre-pandemic levels on rent growth. Of course, the 10 years before the pandemic, rent goes up every single year, but it's traditionally about 2 to 4%. We're getting back to that type of an environment, just normal rental inflation. And we know that rent makes up the um, majority of the inflation data. So this is, as soon as they recognize that, this inflation data should come down significantly. Okay, U.S. single family rent increases also dropped on an annual basis for the 12th consecutive month in April, according to CoreLogic. Significantly less. This 3.7% gain is significantly less than the 14.2% observed the same month in 2022. There are some areas where rent costs are up by 26% since before the pandemic, but we are quickly pulling back to pre-pandemic levels. Single-family rent growth has slowed for a full year, and overall gains are approaching pre-pandemic rates. Since Molly Bosell, principal economist at CoreLogic, prior to 2020, single-family rent gains increased in the range of 2 to 4% for nearly a decade. So that's at 2 to 4% that I'm talking about. And that's, at 3.7% now, we are in that range for annual growth. Obviously, we had this huge growth in the pandemic, that 25%. And it's going to be hard to erase that with the money printing machine that spun for a couple of years in late 2021 and, of course, 22. All right, let's take a look at some of the data. I've got this all available for you in the BAMX, all in one place, so you don't have to go searching through emails anymore. Just make sure you're signed up to BAMX. You also get access to all of our courses. We just released the Tom Tool objection handling course, and of course our live streams and the private Facebook group, along with these daily downloads, now all in one place from the hot sheet. Okay, so here you can see the straight line down. This is huge deceleration for single family rent. The single family rent index year over year percent change by price tier, up over 14% just this time last year. And not only single family, but low tier, low middle tier, high middle tier, and high tier rent prices all pulling dramatically down. This is what really inflation looks like. We make up over a third of inflation on rent prices. This is truly what inflation would look like if they actually took real-time rental data like we've been talking about here on these live streams. Single family rent index year over year percent change in 20 markets. So we've got the 20 markets, 20 biggest markets that CoreLogic is looking at, the light blue being in April of 22 and the darker blue being in April of 2023. Every single one of these 20 markets is lower than they were at this time last year. Look at Miami in 2022, 40% single family rent index, now less than 5% on single family rents. Okay, so this is just single families. Orlando was up at 25%, now closer to 5%. Las Vegas was up over 15%, now in the negatives at negative 0.8%. Phoenix, Arizona, over 15% in 2022. Today, flat, 0%. Seattle, over 10%. Today, basically flat. All right. Those are some of the big increases that pop out, but all 20 of these major markets being tracked by CoreLogic are showing year over year declines. Charlotte had the highest year over year rent price increase in April 2023, but it's still well below where they were in 2022, which was up over 10%. And they were the highest so far for year over year increase. Last year, when you went year over year in Charlotte, it was 12%. Okay, so Charlotte coming in at the highest across the 20 metros at 6.9%. Single family attached versus detached rental price growth. Again, sharp decline. Detached rental prices were up 2.6% in April compared to attached price gains of 4.6%. And then here's a table just looking at rent prices here. Charlotte's rent prices are just over 1,900 for March 2023. That's reflective of that 6.9% year over year. Boston over $3,088. They had the second highest year over year at 6.2%. When we go down to Las Vegas at the negative 0.8%, their monthly numbers coming in at 2133. If you've got one of these markets, the table will be in BAMX, but if you want me to read off one of the markets, the actual number of what the average rent is, just drop into the comments. Honolulu is over $3,500 right now. So hard living in Honolulu, but LA is the same at 3,500. So I guess pick where you want to be. You want to be in Honolulu or LA. They're both the same price on the rent. If you can pull it off in Honolulu, sounds like the place to be. Overall, rent prices are coming down. I've been saying this for a while. Redfin's reported this. You can go back and listen to past streams. This is going to be a common theme. And as we move through the year, you're going to hear more about rent price coming down because inventory on multifamily is not only going up, but there's a record number of multifamily housing units under construction right now. We touched on housing starts. We touched on yesterday's stream. Go back and listen if you missed it. Los Angeles, $3,500 there in Los Angeles. We touched on this yesterday. This finally, builders are in positivity mode. It means for home builders, they're out of a housing recession, right? So for the first time in 11 months, back into positives on the home builder index by NAHB and Wells Fargo. So we talked about that yesterday. We hit on some of these housing start numbers. Okay, I want to dig a little bit deeper here. A record number of multifamily housing units right now are under construction. We've never seen anything like this. And you're going to see a whole bunch of completions come on in Q3 and Q4 for multifamily. This is going to be more inventory added to a lot of these markets, and a lot of these markets that are already decelerating. You saw the chart of the straight down drops are going to drop even further on rent price growth. This is another reason why the Fed should acknowledge that inflation is a lot lower than what they're claiming it to be. Okay. Let's just take a look at multifamily starts and some of the charts that I've pulled out for you over on BAMX. Okay. So housing starts, this is housing starts overall, 2022 and 2023, month over month comparisons. You can see that only in May, as we talked about yesterday, do we have more housing starts for the month than any other month. January, February, March, and April, we were lower. So we're just up slightly here in May. Now, housing starts and completions on 5+ unit structures for the rolling 12 months. Okay. Housing starts now are, up over the 500,000. This is just 5 unit structures and above. This is the highest level we've seen since the 1980s. Okay. The only two levels above this were 70s and 80s. Now, completions right now, we are trending at a number that is greater than any time again since the 80s. There's never been more completions on 5+ unit structures since the 1980s. So starts and completions are way up on 5+ unit structures. That puts the property into that commercial category as well. Housing starts and completions on 1 unit structures. Okay, we are obviously we're up from the last 10 years. Starts you see overall year over year on a rolling 12 is way down, even though we had that May positive news that we reported yesterday, where starts were up for the month, May over May. You can see here for the rolling 12 months, there is a sharp decline on housing starts. Okay. Completions just about on seasonally adjusted rolling 12, just about a million on completions. Okay, so that's what this chart here is showing. This is well off the 2000, 3, 4, 5, 6 time frame where we saw completions and starts both over 1.7 for single family 1 unit structures. Housing units under construction, you have the blue line at 2+ units. So multifamily just screaming up. Housing units under construction for 1 unit, you can see the line pulling down. It is heading straight down, while 2+ units is heading straight up. So we've had some positive news, obviously, as we talked about yesterday, for builders and for housing starts, but there's more inventory, there's more upward trajectory on these multifamily numbers. Multifamily starts increased in May compared to April. Multifamily starts were up 33.2% year over year in May. Single family starts increased sharply in May, but they were down 6.6% year over year. All right, so single family down overall 6.6 for the year, while multifamily was up 33.2% year over year. Multifamily is just it's on a tear with what's happened in the last couple of years on people investing, I believe over investing in the space. This is going to create a glut of inventory, of new inventory, which is going to pull competing rent prices down even further. We referenced the chart from CoreLogic. Rent prices are coming down. They're due to come down even more as some of these completions hit the market. So wanted to dig a little bit deeper on that. If you want the full update on where we are with building, go back and re-listen to yesterday's hot sheet. Okay, interesting. A duo of bipartisan U.S. senators and the director of Consumer Financial Protection Bureau have said that they intend to more closely scrutinize the business practices of house flipping companies. Interesting. Okay, so you've got investors bullish on multifamily, but the government wants to slow down house flipping. They've, with their regulatory, um, you know, guidelines, they've actually supported uh, multifamily, but they want to stop this house flipping. And specifically, companies, after an investigative report alleged that one such entity, Homevestors, let me know in the comments if you know anything about Homevestors, they trained their nearly 1150, so 1,150 franchisees, excuse me, to zero in on homeowners' desperation, according to ProPublica. During a Senate hearing last week, serving as the CFPP's, the Consumer Financial Protection Bureau's semi-annual report to Congress, Senator Tina Smith from Minnesota asked CFPB Director Rohit Chopra about the company and any potential actions that the Bureau could take. Last month, ProPublica reported that a real estate flipping company is targeting vulnerable homeowners using deception and closing tactics. So Smith and Chopra heard during the hearing you that the PB does have a role to play in preventing such issues from going nationwide. Okay, so attacking vulnerable homeowners on going in and buying the property and typically buying it at a deal less than what they could get on the market. I'll go to Twitter for this Twitter handle Ramp Capital LLC, which posted this just yesterday, I believe. Yeah, it was yesterday. In case anyone was wondering, or I'm sorry, in case anyone was considering using Open Door to sell their house, I went under contract 11.5% higher than their bid by putting it on the market. Okay, and Open Doors obviously got in trouble for having deceptive marketing practices. I consider Open Door just basically a house flipping company. I know there's a bunch of tech bros on YouTube and on Twitter that consider Open Door a market maker. I've never considered them a market maker. In fact, their stock topped out in 2021 at $34. You can get it for $3 a share today. So I don't know what market they're making. Ramp Capital guy goes on to say, and if everything goes well, I will also save an additional 1 to 1.5% on fees by going the traditional route by using a real estate agent. Some of the comments were saying you're saying you had a bid and then you listed it on Open Door and got a new bid 11.5% higher. No, he had a bid from Open Door at a set price. Then he listed it onto the traditional market using a real estate agent, got a bid from a real person for 11.5%. But of course, there's more skeptics out there. Somebody then asks, but realtor fees, either way, they would be losing money at that price point. Laugh out loud. And Ramp Capital guy says the fees were higher on Open Door. So he said that, somebody, Tyler Oakland says, well, what was the fee? Open Door charges only 5% fees. Ha, ha, ha. Traditional real estate is 6% split between buying and selling agent. So Ramp Capital guy says, while it was 5% on paper from Open Door, they also included some BS line item about average repairs that took it close to 6.7% on what the fees through Open Door would be. I've actually heard higher than that. Let me know in the comments how high you've heard Open Door. My friend, who's a realtor, took a reduced commission on the sale for this. Hey, friend of Ramp Capital guy, you should have done it for your full commission. Even if your full commission is 6, you would have been lower than Open Door, and you netted them 11.5 on top, regardless of the fees. Listen, Open Door or any of these house flipping companies have got to include fees to get the margin that they need. Okay, and that's also why the price point is lower. And so you can read you can go find that on Twitter. I actually retweeted it at Byron Lazine and read through some of the comments. They're pretty hilarious. But it shows you that this iBuying, house flipping is good for people that are like, I wanna pay, or I wanna pay a higher fee and I want a discounted price on what I sell on my house because I need the convenience. I need it done in a week. I need it done in 2 weeks. I mean, that's what We Buy Ugly Houses, the signs on the telephone poles have always been great at. It's like, hey, you got a house that you haven't taken care of in 30 years and you need the money. I can give you the money in a week. It'll be in your account. You're not going to get financing from the traditional starter home buyer on this property. You're going to go through inspection. It'll take 2-3 months. That's when the 11% discount might make some sense. I need the money for, in a week. I haven't taken care of the property. It's going to be hard to finance the deal. And so I'm going to go, whether it's Open Door or that local investor who's got cash, I'm going to go take the discount because I need the headache off my plate and I need the money in my account. That's always, always going to be a small segment of the market. None of these national home flipping companies or iBuying companies, whatever you want to call them, have figured out a way to close quickly, earn the consumer, the home seller, more money, and do it at a lower fee. It doesn't exist. It sounds too good to be true because it doesn't exist. I talked about this on the 5 a.m. call yesterday. there's this great closing line. You can have things done 2 or 3 ways: fast, cheap, and good. Okay, so if you want them done fast and you want them done good, well, it's not going to be cheap, right? And so what Open Door offers is a higher price for less money. If you want it done fast, and I guess they say it's good because it's done fast. I don't know about that. But if you want it done fast and good, it's not going to be very cheap, right? Or you could spin that to the traditional agent as well. If you want it done fast and cheap, well, then it's definitely not gonna be good. If you want it fast and good, it's not gonna be cheap, and you can just kinda keep working around there. And so to be able to do fast, good, and cheap, it doesn't exist in restaurants, doesn't exist in really almost anything that you do, and Ramp Capital Guy has showcased us that for home flippers. It's interesting that the government and the Justice Department want to take a look at this. They're taking the angle that, hey, we need to help inventory. This is our play to help inventory. Nice, but anytime you're talking about deceptive practices to take somebody's home and profit from that, I'm totally in the camp against that. Obviously, the spokesperson denied the company was targeting elderly and pointed to a 96% approval rate among homeowners. Obviously, this is going to get figured out. There was that one company, maybe somebody in the comments can remind me. They were in Pennsylvania, I think Florida. They were all over the place that were targeting home. They would come in and basically get a lien on these properties. It was a story I covered a while back. Anyways, I don't think this will solve the inventory problem. It's a nice, thing to go out there and do and get some quotes out there for these bipartisan senators, but they've got to start stimulating the top of creating inventory at an affordable price. I'll keep screaming that until somebody actually does it. Let me know your thoughts on some of these house flipping companies, whether the big name like Open Door or some of the others. All right, so big mortgage update, lot to cover here. I'll go through it quickly. May, new home purchase mortgage applications. So we've been talking a lot about new construction this week. New home purchase applications have increased 16.6%. Makes sense because new construction makes up 25% of the inventory. Okay. So Mortgage Banker Association shows mortgage applications for new purchases increased 16.6% from a year ago. Compared to April, this number was up 8%. 8%. So new home construction loans are up. Now, today just reported from Mortgage Bankers Association that weekly mortgage demand across the board was flat. Okay, so last week, the average contract interest rate, as reported by Fannie Mae for the weekly, was around 6.7. That decreased slightly from the week before. We know that Mortgage News Daily has been closer to 6.9. Applications to refinance a home in the last week fell 2%. They were also 40% lower than the same week 1 year ago, and way above that if you go 18 months before the interest rates really started going up. Mortgage applications to purchase a home did increase 2% for the week, so almost flat, but there was a slight increase, which is good. That's 2 weeks in a row of mortgage application demand going up. That number is 32% lower than the same week ago. So significantly less demand for mortgage applications than we were experiencing a year ago. And now the big news that I'd like to share would be on forbearances, because you keep hearing about forbearances. What about the forbearances? Well, share of mortgage loans in forbearance actually decreased to 0.49% in May. This number keeps going down every single month. Revealed the total number of loans now in forbearance decreased by 2 basis points from 0.51 of servicers' portfolio volume in the prior month to 0.49% as of May 31st, 2023. According to NBA's estimate, 245,000 homeowners are still in forbearance plans. Mortgage services have provided for forbearance to approximately 7.9 million borrowers since March 2020. Job market is robust. Most people needed forbearance for a certain period of time. They used it to their advantage, and then they're done with it. Okay, I'm going to have the chart here down below for you for anybody that says, well, I don't know about the the forbearance, it's still a concern for me. Just show them this chart, whether it's Ginnie, Fannie and Freddie, other portfolio loans, or the total amount of loans. They are all well off anywhere they were in 2020. And again, down to less than 250,000 from a peak of near 8 million on the forbearance. So there's your forbearance update. Let's take a look at the 10-year and see where we are at today. Yesterday, we were down a tick, and today we are up a tick to 3788. We've been kind of living in this 37 to 38 range, as you can see here on Wall Street Journal's 1 month look back. The last 30 days, it's been bouncing between that 37 and 38 range, which is reflected in the 30-year, which follows the 10-year to be kind of holding firm in the high sixes, certainly over 6.25, or just about 6.25 on Freddie Mac's fixed weekly survey. And then the Mortgage News Daily survey has been living around 6.9. We did get a little bit of good news yesterday as it dropped under 6.9 to 6.87 on the daily survey from Mortgage News Daily. All right. Here's your hot sheet today. Really appreciate you guys tuning in. If you want those daily downloads and everything that we do here on the hot sheet, jump down below and get into the BAMX community. The Facebook community is on fire. The live streams are just absolutely fantastic. And of course, all of the courses that we have on there as well. You get all of that plus the daily downloads here for BAMX all in one place, for the hot sheet rather, on BAMX in one place. All right. Hope everybody has a great Wednesday, and until tomorrow, toodaloo.